Warren Buffett's Ground Rules. Words of wisdom from the partnership letters of the world's greatest investor. The excerpts from Warren Buffett's partnership letters are being used with his permission. Mr. Buffett has had no other connection with this book whatsoever. In other words, while all the wisdom is his, all the errors are mine. To maintain the narrative flow of the excerpts, omissions are not always indicated. Introduction. If I was running $1 million or $10 million for that matter, I'd be fully invested. The highest rates of return I've ever achieved were in the 1950s. I killed the Dow. You ought to see the numbers. But I was investing peanuts back then. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that. Warren Buffett, Business Week, 1999. In 1956, Warren Buffett was working in New York with his mentor, Value Investing's founder Benjamin Graham. When Graham decided to retire, he offered his best student a stake in his partnership, Graham Newman, but the 25-year-old Buffett opted to return home instead. Not long after, at the bequest of 4 family members and 3 friends, a new investment partnership, Buffett Associates Limited, was formed. Before agreeing to accept their checks, however, he asked them to meet him for dinner at the Omaha Club. Everyone went Dutch. That night, Buffett handed each of them a few pages of legal documents containing the formal partnership agreement and suggested they not worry too much about what was in them. He assured them there would be no surprises. The gathering was intended to discuss something he considered much more important: the ground rules. He had made carbons of this short list of precepts and carefully went through each point. Buffett insisted on complete autonomy. He was not going to talk about what the partnership was actually doing. He gave very little detail on his actual holdings. He told them, "These ground rules are the philosophy. If you're in tune with me, then let's go. If you aren't, I understand." The ground rules. 1. In no sense is any rate of return guaranteed to partners. Partners who withdraw 0.5% monthly are doing just that, withdrawing. If we earn more than 6% per annum over a period of years, the withdrawals will be covered by earnings and the principal will increase. If we don't earn 6%, the monthly payments are partially or wholly a return of capital. 2. Any year in which we fail to achieve at least a plus 6% performance will be followed by a year when partners receiving monthly payments will find those payments lowered. 3. Whenever we talk of yearly gains or losses, we are talking about market values, that is, how we stand with assets valued at market at year-end against how we stood on the same basis at the beginning of the year. This may bear very little relationship to the realized results for tax purposes in a given year. 4. Whether we do a good job or a poor job is not to be measured by whether we are plus or minus for the year. It is instead to be measured against the general experience in securities as measured by the Dow Jones Industrial Average, leading investment companies, etc. If our record is better than that of these yardsticks, we consider it a good year whether we are plus or minus. If we do poorer, we deserve the tomatoes. 5. While I much prefer a 5-year test, I feel 3 years is an absolute minimum for judging performance. It is a certainty that we will have years when the partnership performance is poorer, perhaps substantially so, than the Dow. If any 3-year or longer period produces poor results, we all should start looking around for other places to have our money. An exception to the latter statement would be 3 years covering a speculative explosion in a bull market. 6. I am not in the business of predicting general stock market or business fluctuations. If you think I can do this, or think it is essential to an investment program, you should not be in the partnership. 7. I cannot promise results to partners. What I can and do promise is that a. Our investments will be chosen on the basis of value, not popularity. b. That we will attempt to bring risk of permanent capital loss, not short-term quotational loss, to an absolute minimum by obtaining a wide margin of safety in each commitment and a diversity of commitments, and C. My wife, children, and I will have virtually our entire net worth invested in the partnership. Everyone invited to the Omaha Club that night signed on, and Buffett took their checks. As new partners joined, they were each carefully taken through the ground rules. Then, every partner was sent an updated copy annually. Over the years that followed, Buffett communicated his performance and described his activities through a series of letters to this small but growing band of followers. He used them as a teaching tool to reinforce and expand upon the concepts behind the ground rules, discuss his expectations for future performance, and make comments about the market environment. At first, these were annual updates, but when enough partners griped that a year was a long time between drinks, he began writing at least semi-annually. These partnership letters chronicle his thoughts, approaches, and reflections in the period immediately prior to his better-known tenure at Berkshire Hathaway. It was a period that delivered an unprecedented record of investing success, even when compared to his track record at Berkshire. While he expected to have good years and bad, he thought that a 10% advantage to the Dow was achievable over most 3 to 5 year periods, and that's what he set to do. He did far better. He consistently beat the market and never had a down year. For the entire period, he compounded partners' capital at nearly a 24% annual rate after fees. This earlier period produced many of the best performance years of his career. The lessons that come out of this commentary offer timeless guidance for every type of investor, from beginners and amateurs to sophisticated pros. They lay forth a consistent and highly effective set of principles and methods that avoid the trendy and technical temptations abundant in today's or any day's market. While they do contain the type of sophisticated analysis that should appeal to seasoned professionals, the letters also are Buffett's take on investing 101. They provide a basic, common-sense approach that should resonate with everyone. The partnership letters and their wisdom have been compiled comprehensively and accessibly for the first time in this book and include such bedrock principles as his contrarian diversification strategy, his almost religious celebration of compounding interest, and his conservative, as opposed to conventional, decision-making process. They also include his methods for investing in generals, workouts, and controls, his 3 principal methods of operation, which evolved in interesting and important ways over time, ways that we'll explore. Essentially, the letters have tremendous value because they describe the mindset of a successful young investor working initially with very modest sums, a mindset that investors can adopt and use to achieve long-term success as they venture into the market themselves. They make a powerful argument for a long-term, value-oriented strategy, one that is especially viable in turbulent times such as our own, when people are vulnerable to a speculative, oftentimes leveraged, short-term focus that is rarely effective in the long run. They provide timeless principles of conservatism and discipline that have been the cornerstone of Buffett's success. If a young Buffett were starting his partnership today, there is little doubt he would achieve the same tremendous results. In fact, he's in print guaranteeing that he could earn 50% annual returns on just a few $1,000,000 today. This high rate of return on a small sum would be just as feasible now as it was years ago, because market inefficiencies remain, especially in smaller, less followed businesses, and because he's a brilliant investor. However, as long as stocks continue to have short memories, oscillating in value because of fear and greed, opportunities for terrific returns will always exist for all enterprising investors who can adopt the proper mindset. As much as ever, many today lack the steadfastness to stay true to the discipline that value investing requires. In letter after letter, Buffett returns to the unchanging nature of his principles. It's an attitude over IQ approach. Staying true to one's process without getting drawn in by the trends is one of the hardest things for even the most seasoned investors. Everyone can learn from Buffett's mastery of his own investment emotions. Each chapter in this book is organized around a single idea or theme from the letters and follows the same basic format, starting with a summary essay intended to provide some of the backstory. Hopefully, this will add historical context and allow for a fuller appreciation of the relevance of the content in our time. Then all the critical excerpts from the letters on each topic are presented in full. This not only allows for long drinks from the well of Buffett's own writing, but should also allow the book to be a useful reference tool for sourcing his work from this period. Aggregating all the commentary on a given topic in its own chapter is often revealing. We can see various patterns emerge over multiple letters where he's revisiting certain ideas and track the progression of his thinking, something that can be more difficult to pick up on when the letters are read chronologically. Buffett has never published a textbook on investing, at least in the traditional sense of the word. What we do have, in addition to the articles he's written and the notes that have been taken from his talks and speeches, are his letters. In effect, these represent a correspondence course that has continued from 1957 to this day, the entire length of his career. The partnership letters represent the first section in that course, and I'm delighted to be sharing them with you. I hope you enjoy reading them as much as I have enjoyed putting them together. I am grateful to Mr. Buffett for entrusting me in the use of his letters in this book, and note once again that he wasn't otherwise involved in this project. I've aimed to present his material in a manner that I hope he approves of, and in a way that makes his teaching accessible to emerging investors and seasoned professionals alike. Part 1. Chapter 1. Orientation. The availability of a quotation for your business interest, stock, should always be an asset to be utilized if desired. If it gets silly enough in either direction, you take advantage of it. July 12, 1966. Picture yourself in Omaha, Nebraska. It is early one evening in the fall of 1956. Elvis just debuted on The Ed Sullivan Show, and Eisenhower is in the White House. Tonight, you and 20 other adults are filing into a classroom at the University of Nebraska, Omaha, for the first lecture in a course called Investment Principles. Your teacher will be a 20-something named Warren Buffett. As it turns out, you've chosen the seat next to Buffett's Aunt Alice, one of the original 7 investors in his first partnership. I like to think of this book in its own way as a recreation of that early Investing Principles class, drawing on the lessons he taught in the partnership letters that were written during the very time this course was offered. It's your annotated guide to the basics of intelligent investing, as told through the key excerpts from almost 40 of these early letters. These were the pre-Berkshire years, 1956 to 1970, a time when his capital was modest and his opportunity set was unbounded. It was a time, especially in the early days of the partnership, when he was most like you and me in that he was able to invest in nearly everything, when no companies were too small for him to be interested. Buffett, while investing during the day, really did teach an evening class throughout the late 1950s and 1960s, and his Aunt Alice, along with a few other eventual partners, really did attend his class. After completing Dale Carnegie's course to overcome his discomfort with public speaking, Buffett taught as a way to keep up his skills. Not only that, but he was following the example of his mentor, Ben Graham, who in addition to writing letters to his investors, also taught a course on securities analysis at Columbia Business School, while running Graham Newman, his investment company. The Bedrock Principles of Benjamin Graham. There is no better place to start a book on basic intelligent investing than with the foundational tenet of Buffett's general thinking, one that's universally shared by Graham's disciples. The market can and will at times be completely deranged and irrational in the short term, but over the long term it will price securities in line with their underlying intrinsic values. Buffett uses his mentor's somewhat paradoxical idea as a teaching tool throughout the letters Because it so effectively distinguishes what we're actually after as investors. Consistently sound, rational business analysis based on logic and good reasoning that leads to the selection of securities offering the highest potential return with the lowest possible amount of corresponding risk. That's the long-term investor's approach, and it's a very different approach from trying to generate gains by speculating on what other investors will or will not do, or by making guesses around short-term changes in macro variables like oil prices or interest rates. Investors, as we'll come to define the term, buy businesses. Speculators play markets. Investors learn to see short-term gyrations in stock prices as basically random squiggles and believe they can be largely ignored. Then, because they are seen as random, no attempt is made to systematically predict them. This is simply not our game. Over the long term, however, markets do tend to get it right and ultimately reflect the economic experience of a business into the price of its stock. Knowing this, investors therefore focus on solid long-term business analysis and conservative reasoning. That's what we believe leads to above-average results over time. This big foundational principle comes directly from Ben Graham, Buffett's teacher, former employer, hero, and the man who practically invented securities analysis. Known as the Dean of Wall Street, Ben Graham was a revolutionary, the first to turn what had formerly been somewhat of a dark art into a real profession. Buffett was consumed by Graham's ideas from the moment he encountered them, so much so that he even named his son, who was in line to become the next non-executive chairman of Berkshire Hathaway, Howard Graham Buffett. Grasping Buffett's investing principles, the part that's remained constant from the partnership years all the way through to the present day, requires a firm understanding of several of Graham's foundational ideas and influences. Here's how it all began. Buffett graduated a year early from the University of Nebraska-Lincoln in 1950 at the age of 19. He then applied to Harvard Business School but was told he would have a better chance if he reapplied in a few years. Getting turned down by Harvard was one of the luckiest things that ever happened to him. As he began looking at other business schools, he came across Columbia's catalog. In it, he discovered that the author of his favorite book, The Intelligent Investor, was not only alive but also teaching there. Buffett immediately applied. Several weeks later, he applied in August, he was enrolled at Columbia, and not too long after that he was sitting in Graham's classroom as the star pupil. One can only imagine the intensity of the intellectual dynamic between these two men. Graham was laying Buffett's intellectual foundation, and Buffett, the only student to get an A+, was picking up on everything Graham was putting down. After graduation, Buffett was absolutely desperate to work for Graham's investment company, but, as he later joked, he was turned down for being overvalued, despite an offer to work for free. The real reason he didn't get the job was probably more linked to Graham Newman being one of only a few Jewish-owned investment companies. Buffett could get a good job elsewhere, but other highly qualified Jews, if turned down by Graham, might be otherwise shut out. Disappointed, he returned to Omaha to join his dad in the securities brokerage business, where he continued pursuing the idea of working with Graham. A 3-year steady stream of letters and stock ideas was all it took. His mentor finally relented and invited him back to New York in 1954. Buffett didn't get much time at Graham Newman, though. A year after he joined, Graham decided to retire. Once again, now at the age of 25, Buffett returned to Omaha, although this time he didn't return to brokering stocks with his dad again. This time, against the advice of both Graham and his father, he started an investing partnership of his own. He structured it in the image of what Graham had set up and operated it mostly according to his principles. Graham and Buffett remained very close all the way through Graham's passing in 1976. Mr. Market. Graham's most valuable explanation of exactly how short-term market inefficiency works was crystallized in his concept of Mr. Market. The idea is that a securities market can be thought of like a moody, manic-depressive fellow who stands ready to buy or sell you a half stake in his business every day. His behavior can be wild and irrational and is difficult to predict. Sometimes he's euphoric and thinks highly of his prospects. Here, he'll offer to sell you his stake only at the highest of prices. At other times, he's depressed and doesn't think much of himself or his business. Here, he offers to sell you the same stake in the same business at a much lower bargain price. Oftentimes, he's neutral. While you can never be sure what mood you will find him in, you can be sure that regardless of whether you trade with him today, Mr. Market will be back again with a new set of prices tomorrow. Viewing the market through the lens of Graham's allegory reveals why the market price on any given day should not inform our view of a security's underlying intrinsic value. We must arrive at that figure independently, and then only act when Mr. Market's mood is in our favor. That is what Buffett is driving home in his letters when he teaches, "A market quote's availability should never be turned into a liability, whereby its periodic aberrations in turn formulate your judgments. If you rely on the market's price to value a business, you're apt to miss opportunities to buy at times when he's depressed and sell when he's manic. You can't let the market do your thinking for you. Investors know they have to do their own work." When you own a stock, you own a business. The work, of course, is the appraisal of business value. While short-term prices may be at the mercy of Mr. Market's mood, over the long term a stock is going to approximately track the underlying intrinsic value of the business. Or, as Graham put it, "In the short term the market is like a voting machine, but in the long term it's more like a weighing machine." This is true because a stock, by definition, is a fractional ownership claim on an entire company. If we can value the business, we can value the stock. It's a mathematical certainty that a company's shares, in aggregate and over the entire span of the corporation's lifetime, must produce a return exactly in line with the results of the company's business. Yes, some shareholders will do better than others in the interim, depending on the timing of their purchases and sales. But in aggregate, and in the end, the results of all the savvy or lucky outperformers will be matched dollar for dollar by an equal amount of underperformance from those who are naive or unlucky. Therefore, investors who, through sound analysis, are able to surmise the long-term future returns of a business will likely get those same long-term future returns through the ownership of its shares, as long as they are careful not to overpay. That is why investors play for the long term. We learn through Buffett's teaching to focus our efforts on the business, not the short-term timing of when sound investments are likely to pay off. As Buffett wrote, "The course of the stock market will determine, to a great degree, when we will be right. But the accuracy of our analysis of the company will largely determine whether we will be right. In other words, we tend to concentrate on what should happen, not when it should happen." This idea is consistently stressed throughout the letters, so I'll stress it again here. Stocks are not just pieces of paper to be traded back and forth. They are claims on a business, many of which can be analyzed and evaluated. If market prices of businesses, stocks, move below intrinsic values for any extended period of time, market forces will eventually act to correct the undervaluation because in the long term, the market is efficient. When is not the relevant question because it's dependent on Mr. Market, who is not reliable. It's hard to know at the time of purchase what's going to get him to wake up to the value you might see as being plainly there. However, companies often buy back their stock when they recognize it's cheap. Larger companies and private equity firms often look to acquire undervalued companies in their entirety. Market participants, aware of the potential for all of the above, often hunt for and buy such bargains, which in and of itself helps remove the discount. Buffett teaches investors to trust that the market will get it right eventually. He focuses us on finding the right businesses at the right prices, largely ignoring the timing of when to buy or when to expect the investment to work out. Market guessing. Another lesson Buffett stresses is that the market's mood swings can be random, making them, by definition, often unpredictable. Trying to figure out what's going to happen in the short term is simply too hard, and so his views on macro variables, general view on stocks, rates, FX, commodities, GDP, play no part in his investing decisions. Criticisms of those who use short-term predictions to make buy or sell decisions in stocks are peppered throughout the letters. He enjoys quoting Graham. Speculation is neither illegal, immoral, nor fattening financially. To this day, Buffett has remained true to this idea. There are just too many variables at play. Nonetheless, many Wall Street professionals continue to make these types of predictions. One need only turn on the television to see these market pundits, all seemingly following Lord Keynes's derisive advice. If you can't forecast well, forecast often. As investors, we understand that the right answer to questions about what stocks, bonds, interest rates, commodities, etc. are going to do over the next day, month, quarter, year, or even several years is, I don't have the first clue. Through Buffett's insights, we learn not to fall victim to the siren songs of these expert opinions and churn our portfolios, jumping from guesstimate to guesstimate, and allowing what could otherwise be a decent result to be consumed by taxes, commissions, and random chance. According to Buffett, predictions often tell you more about the forecaster than they do about the future. Some advice naturally follows. Give yourself permission to embrace the I don't have the first clue mode of thinking. It will free you from wasting valuable time and effort and allow you to focus on thinking from the vantage point of the owner or prospective owner of an entire business you might understand and come to find as attractive. Who would sell a farm because they thought there was at least a 65% chance the Fed was going to raise rates next year? Also, be skeptical of anyone who claims to have a clear view into the future. Here again, we are reminded that you really can't outsource your thinking. You have to do it yourself. Your paid advisors, whether they do it willingly or not, will likely only steer you in the direction of doing what's good for them. It's just human nature. A good deal of Buffett's astonishing success during the partnership years and beyond has come from never pretending to know things that were either unknowable or unknown. His teaching encourages other investors to embrace a similar agnostic attitude and to think for themselves. Predictable pullbacks. Inclusive in the list of unknowables is when a big drop in the market is going to come. This is yet another key orienting principle that Buffett drew from Graham and Mr. Market. The market is inevitably going to slump into truly dour moods from time to time. Very little can typically be done to avoid getting caught in the downdrafts. Buffett reminds investors that during such periods, even a portfolio of extremely cheap stocks is likely to decline with the general market. He stresses this as an inevitable part of owning securities, and that if a 50% decline in the value of your securities portfolio is going to cause you hardship, you need to reduce your exposure to the market. The good news is that the occasional market drop is of little consequence to long-term investors. Preparing yourself to shrug off the next downturn is an important element of the method Buffett lays out. While no one knows what the market is going to do from year to year, odds are we will have at least a few 20 to 30% drops over the next decade or two. Exactly when these occur is of no great significance. What matters is where you start and where you end up. Shuffle around the order of the plus and minus years and you still come to the same ultimate result in the end. Since the general trend is up, as long as a severe 25 to 40% drop isn't going to somehow cause you to sell out at the low prices, you're apt to do pretty well in stocks over the long run. You can allow the market pops and drops to come and go, as they inevitably will. Unfortunately, those who lack this mindset often fall victim to their emotion and sell out of fear after markets have already declined. According to one study done by Fidelity, The best performing of all their account holders were those who literally forgot about their portfolios. While most investors were selling when the market outlook became worrisome or even cloudy, those who ignored market sell-offs or forgot they were invested at all did vastly better. This is a great example. To be a successful investor, you need to separate your emotional reaction to a plunge from your cognitive ability as a rational appraiser of long-term business value. You can never let the market quote turn from an asset to a liability. Graham described this brilliantly in The Intelligent Investor. The true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. From the Partnership Letters: Speculation, Market Guessing, and Pullbacks. January 18, 1965. My own investment philosophy has developed around the theory that prophecy reveals far more of the frailties of the prophet than it reveals of the future. July 12, 1966. I am not in the business of predicting general stock market or business fluctuations. If you think I can do this, or think it is essential to an investment program, you should not be in the partnership. Of course, this rule can be attacked as fuzzy, complex, ambiguous, vague, etc. Nevertheless, I think the point is well understood by the great majority of our partners. We don't buy and sell stocks based upon what other people think the stock market is going to do. I never have an opinion, but rather upon what we think the company is going to do. The course of the stock market will determine, to a great degree, when we will be right, but the accuracy of our analysis of the company will largely determine whether we will be right. In other words, we tend to concentrate on what should happen, not when it should happen. In our department store business, I can say with considerable assurance that December will be better than July. Notice how sophisticated I have already become about retailing. What really counts is whether December is better than last December by a margin greater than our competitors, and what we are doing to set the stage for future Decembers. However, in our partnership business, I not only can't say whether December will be better than July, but I can't even say that December won't produce a very large loss. It sometimes does. Our investments are simply not aware that it takes 365 days for the Earth to make it around the Sun. Even worse, they are not aware that your celestial orientation, and that of the IRS, requires that I report to you upon the conclusion of each orbit, the Earth's, not ours. Therefore, we have to use a standard other than the calendar to measure our progress. This yardstick is obviously the general experience in securities as measured by the Dow. We have a strong feeling that this competitor will do quite decently over a period of years. Christmas will come even if it's in July. And if we keep beating our competitor, we will have to do something better than quite decently. It's something like a retailer measuring his sales gains and profit margins against Sears. Beat them every year and somehow you'll see daylight. I resurrect this market guessing section only because after the Dow declined from 995 at the peak in February to about 865 in May, I received a few calls from partners suggesting that they thought stocks were going a lot lower. This always raises two questions in my mind. 1. If they knew in February that the Dow was going to 865 in May, why didn't they let me in on it then? And 2. If they didn't know what was going to happen during the ensuing 3 months back in February, how do they know in May? There is also a voice or two after any 100-point or so decline suggesting we sell and wait until the future is clearer. Let me again suggest 2 points. 1. The future has never been clear to me. Give us a call when the next few months are obvious to you, or for that matter, the next few hours. And 2. No one ever seems to call after the market has gone up 100 points to focus my attention on how unclear everything is, even though the view back in February doesn't look so clear in retrospect. If we start deciding, based on guesses or emotions, whether we will or won't participate in a business where we should have some long-run edge, we're in trouble. We will not sell our interests in businesses, stocks, when they are attractively priced just because some astrologer thinks the quotations may go lower, even though such forecasts are obviously going to be right some of the time. Similarly, we will not buy fully priced securities because experts think prices are going higher. Who would think of buying or selling a private business because of someone's guess on the stock market? The availability of a quotation for your business interest, stock, should always be an asset to be utilized if desired. If it gets silly enough in either direction, you take advantage of it. Its availability should never be turned into a liability whereby its periodic aberrations in turn formulate your judgments. A marvelous articulation of this idea is contained in Chapter 2, The Investor and Stock Market Fluctuations, of Benjamin Graham's The Intelligent Investor. In my opinion, this chapter has more investment importance than anything else that has been written. January 24, 1968. My mentor, Ben Graham, used to say, "Speculation is neither illegal, immoral, nor fattening financially." During the past year, it was possible to become fiscally flabby through a steady diet of speculative bonbons. We continue to eat oatmeal, but if indigestion should set in generally, it is unrealistic to expect that we won't have some discomfort. January 24, 1962. I think you can be quite sure that over the next 10 years there are going to be a few years when the general market is plus 20% or 25%, a few when it is minus on the same order, and a majority when it is in between. I haven't any notion as to the sequence in which these will occur, nor do I think it is of any great importance for the long-term investor. January 18, 1965. If a 20% or 30% drop in the market value of your equity holdings, such as BPL, is going to produce emotional or financial distress, you should simply avoid common stock type investments. In the words of the poet Harry Truman, "If you can't stand the heat, stay out of the kitchen." It is preferable, of course, to consider the problem before you enter the kitchen. Wisdom Compounded. Through Buffett's commentary and Ben Graham's Mr. Market allegory, we can absorb these principles and integrate them into our foundational thinking about how markets work and how we should behave in them. Thinking of ourselves now as investors, we come to understand short-term fluctuations in securities prices are often driven by swings in market psychology. But over multi-year periods, investing results will be determined by the underlying fundamental results of the businesses we own and the prices we paid. Market swoons are inevitable, and since we can't predict their timing, we accept them as our price of admission as investors. The swoons do not bother us much because we understand that the availability of a market quote is an advantage to be utilized, allowing us to be buyers at times when others are fearful. It provides the mental construct for the fortitude during swoons in the market that keeps us from selling out at low prices. Even investors who live below their means and consistently look to invest the difference in the broad market without attempting to pick stocks or value businesses should do far better than average if they possess the emotional fortitude to follow these principles. In fact, investors who are able to adhere to these core ideas throughout an investing lifetime will have a hard time not becoming comfortably wealthy, in large part due to the power of compound interest, the subject of our next chapter. Chapter 2. Compounding. Such fanciful geometric progressions illustrate the value of either living a long time or compounding your money at a decent rate. I have nothing particularly helpful to say on the former point. January 18, 1963. Einstein is said to have called compound interest the eighth wonder of the world, and said that those who understand it earn it, and those who don't pay it. Using humorous stories throughout the letters, Buffett teaches investors that the power of compounded interest is unmatched by any other factor in the production of wealth through investment. Compounding over a lifelong investment program is your best strategy, bar none. At its very root, an investment program is first and foremost a compounding program. It is the process of continuously reinvesting gains, such that each subsequent edition begins earning a return itself. These gains on gains become an increasingly dominant component of an investment program's total returns over time. The two determining factors of the ultimate result are 1. The annual average rate of gain, and 2. Time. Compounding derives its power from its parabolic nature. The longer it goes, the more impactful it becomes. However, it does take significant amounts of time to build sufficient scale to become an obvious driver within an investment program, and so many underappreciate its importance. If you latch on early to these ideas and give it time, you won't need much else to be a successful investor. Unfortunately, many are short-sighted or impatient and fail to take full advantage of what they offer. Take, for example, a $100,000 account earning 10% a year. The total return will be about 7% higher when the gains are reinvested rather than harvested after a 5-year period. Not that impressive. However, after 10 years, the account that reinvests its gains, let's call this account the compounder, will produce 30% more than one that doesn't reinvest. Then, the pulse-quickening results start to get going by year 15. Now the compounder is doing roughly 70% better. Compounding is exponential. It builds momentum as it goes. After 20 years, the advantage widens to 125%. There is nothing more powerful. Spending away your gains will diminish your total return significantly. As investors, we allow our gains to pile up upon themselves as the primary driver of our wealth creation. We do it patiently. Compounding's importance is hard to overstate. It explains why Charlie Munger, Buffett's friend in the partnership years and current vice chairman of Berkshire, once said Buffett viewed a $10 haircut like it was actually costing him $300,000. Turns out, he was only modestly conservative. A $10 haircut skipped by Buffett in 1956 and instead invested in the partnership would be worth more than $1 million today. $10 compounded at 22% for 58 years. Viewed through Buffett's compound interest lens, it's not hard to see why he has lived such a frugal life. His haircuts really are expensive. Buffett was convinced by his mid-20s that the power of compound interest was going to make him rich. Returning to Omaha with a little over $100,000 before starting the partnerships, he already considered himself to be essentially retired. He figured he would read a lot and perhaps attend some university classes. He was so sure of what compound interest would do that he literally began worrying about the potentially adverse effect all this coming wealth might have on his family. He didn't want spoiled kids and wanted a strategy to keep them grounded. While avoiding spoiled children is an understandable concern in and of itself, keep in mind he was in his 20s at the time and working out of his bedroom investing very modest sums. Some advice naturally follows from all of this. If you can manage to underspend your income while achieving even a modestly better than average return, you are likely to be just fine financially. Patience, however, is critical. You can't force compounding. You have to let it season over time. Consider the case of Ronald Reed, a gas station attendant from Vermont who amassed an $8 million net worth by consistently investing a small portion of his salary into high-quality, dividend-paying stocks over a lifetime. Buffett has resided in the same house for decades. His approach to life and investing is pragmatic and fulfilling. His patience and frugality have allowed him to keep the maximum amount of funds invested and compounding. This, in combination with the high rates of return he's been able to generate, has led to an ability to give all his Berkshire stock to the Gates Foundation, the largest philanthropic gift in the history of the world. Not only that, he's one of the happiest guys I can think of, having done exactly what he wanted with the majority of each and every day of his adult life. The joys of compounding. When talking to partners about the power of compound interest, Buffett included the table that's on the PDF enhancement, showing the gains from compounding $100,000 for 10 to 30 years at a rate between 4% and 16%. Take a minute to absorb these numbers. Scan the figures in the upper left and work your way down to the bottom right. Notice the huge advantage financially from a long investment life and the huge advantage that comes with a high rate of return. If you can combine the two factors, the results are eye-popping. $100,000 compounded at 16% will be worth more than $8.5 million in 30 years. Buffett relates 3 amusing stories in the letters of Columbus, Mona Lisa, and the Manhattan Indians, which are in full at the end of the chapter, to emphasize these points for us. 1. Compounding is equally sensitive to changes in time as it is to changes in rate, and 2. Seemingly insignificant changes in rate really add up when viewed through the lens of a long-term investment program. The story of Christopher Columbus emphasizes his point that when it comes to compound interest, time is definitely on your side. As you'll hear, had Queen Isabella not spent the $30,000 to finance Columbus's voyage and had instead invested in anything that was compounding at just 4% annually, it would have grown to be worth $2 trillion by 1963, $7.3 trillion today. As Buffett joked, without attempting to evaluate the psychic income derived from finding a new hemisphere, it must be pointed out that even had squatters' rights prevailed, the whole deal was not exactly another IBM. With the benefit of long periods of time, even modest amounts of initial capital invested at modest rates pile up into staggering sums. Take a moment to look again at the table of compound interest, this time with a focus on the 8% return column. 10 years of compounded interest produces a $115,892 gain. Double the length of time, and the gain triples. Triple the length of compounding to 30 years from 10, and the gain increases almost 9-fold. In the second story, Buffett tells the tale of King Francis I of France, who paid $20,000 for the Mona Lisa. Here, Buffett illustrates how a high rate of return and a long period of time produce an absurdity if extrapolated out too far. If that same $20,000 were to somehow have compounded instead at 6% annually, it would have grown to $1 quadrillion by 1964, nearly 3,000 times the national debt at the time. Buffett may have been speaking directly to his wife, a lover of art and a gallery owner for a time, when he said, "I trust this will end all discussion in our household about any purchase of paintings qualifying as an investment." There is no question that a long time period and a high rate of growth combine to produce nonsensical projections when allowed to go too far. This is why Buffett was always trying to keep partners from extrapolating his results too far into the future. As an example, in 1963 he said, "Some of you may be downcast because I have not included in the table the rate of 22.3%. This rate, of course, is before income taxes, which are paid directly by you, not the partnership. Even excluding this factor, such a calculation would only prove the absurdity of the idea of compounding at very high rates, even with initially modest sums." To give you a more modern example, under Buffett's stewardship, Berkshire has been able to compound its per-share value by 21.6% annually for the last 50 years. The stock, which traded for around $18 in 1965, is worth a staggering $218,000 per share as of this writing, 2015. The total market value of the company today is $359 billion. If Berkshire's stock manages to compound annually at the same rate, the per-share value will be $3.8 billion by 2065, and the market value will be over $6 quadrillion, far more than the value of all the public companies on the planet combined. As you can see, continued high rates of growth become impossible to sustain. The larger an investment program becomes, the harder it is to grow. This is the law of large numbers at work, and Buffett, from the partnership letters to today, has always been very candid in this regard. Today, Berkshire is simply too big to grow a lot faster than the general economy. What's at stake for today's investors? Buffett estimated the overall market would compound somewhere between 5% and 8% per year on average and over a long period of time. Looking back, the S&P 500 has actually delivered a little more than a 7% compound annual growth rate, CAGR, since 1950, and the average of all the 10-year periods since has been 6.8%. With untaxed dividends added back, it's been closer to 10%. These better-than-expected results come in large part from the unexpected drop in interest rates. The lower the government bond yield, the more valuable stocks will be, all else equal. Today, with bond yields not too far from zero, a 5 to 6% per annum result over the next 20 to 30 years seems like a reasonable assumption. If we get those kinds of results, the power of compound interest will be just as important, but it will take longer for the effects to gain momentum. My 5 to 6% figure is just a guesstimate. You can make your own. Buffett offered his most detailed description of how he was thinking it through in a letter written in October 1969, just as he was winding up the partnership. This was part of a letter to help partners, who would soon be on their own as investors, think about what proportion of their capital should be in stocks and what the returns might look like. The 10-year expectation for corporate stocks as a group is probably not better than 9% overall, say 3% dividends and 6% gain in value. I would doubt that gross national product grows more than 6% per annum. I don't believe corporate profits are likely to grow significantly as a percentage of GNP. And if earnings multipliers don't change, and with these assumptions and present interest rates they shouldn't, the aggregate valuation of American corporate enterprise should not grow at a long-term compounded rate above 6% per annum. This typical experience in stocks might produce, for the taxpayer described earlier, 1.75% after tax from dividends and 4.75% after tax from capital gain, for a total after-tax return of about 6.5%. The pre-tax mix between dividends and capital gains might be more like 4% and 5%, giving a slightly lower after-tax result. This is not far from historical experience, and overall, I believe future tax rules on capital gains are likely to be stiffer than in the past. Whatever outcome the stock market is going to deliver to you over your investment lifetime, Buffett's final story in his compounding trilogy serves to really hammer home how even minor decrements down, small fractional changes in the compound rate, produce hugely different outcomes over long periods. In an amusing story, Buffett figures the $24 paid to the Indians for the island of Manhattan was worth about $12.5 billion in 1965, working out to about a 6.12% compounded gain. But he was making a point. To the novice, perhaps this sounds like a decent deal. However, the Indians have only had to achieve a 6.5% return, the tribal mutual fund representative would have promised them this, to obtain the last laugh on Minuit. At 6.5%, $24 becomes $42,105,772,800, $42 billion in 338 years. And if they just manage to squeeze out an extra half point to get to 7%, the present value becomes $205 billion. This story serves us a powerful reminder. Fees, taxes, and other forms of slippage can add up to have an enormous cumulative impact. While 1 to 2% a year in such costs seems minor when isolated to a given year, and you can be sure that's how financial products are sold, The power of compounding turns something that looks minor into something that, in reality, is actually colossal. Consider the huge swing in outcomes that exists for a middle-aged investor saving in a 401k retirement account for the next 20 to 30 years at 5% versus 7%. The effect of missing out on 2% per year for 30 years results in an account that is worth half as much. Buffett's story of the Manhattan Indians makes it all so plainly obvious. Every percentage point in the rate of compounding really matters. Fees and taxes, not to mention underperformance, have been crushing the long-term investment results of most Americans. In fact, the actual average result of individual investors in this country in the 20 years ending 2011 has been closer to 2%. In real dollars, after inflation, purchasing power has been lost. It's a scandalous state of affairs relative to the 7.8% delivered by the market index. Buffett and others have been sounding this alarm for decades, but these practices continue. Investors take the long view and think of stocks as fractional ownership claims on businesses. They don't get spooked by the market swings and avoid fees and taxes to the fullest extent practical. They harness the parabolic nature of long-term compound interest at the highest rate for the longest period of time possible. It's your primary tool as an investor. From the Partnership Letters, The Joys of Compounding. January 18, 1963. Columbus. I have it from unreliable sources that the cost of the voyage Isabella originally underwrote for Columbus was approximately $30,000. This has been considered at least a moderately successful utilization of venture capital. Without attempting to evaluate the psychic income derived from finding a new hemisphere, it must be pointed out that even had squatters' rights prevailed, the whole deal was not exactly another IBM. Figured very roughly, the $30,000 invested at 4% compounded annually would have amounted to something like $2 trillion. That's $2 trillion for those of you who are not government statisticians by 1962. Historical apologists for the Indians of Manhattan may find refuge in similar calculations. Such fanciful geometric progressions illustrate the value of either living a long time or compounding your money at a decent rate. I have nothing particularly helpful to say on the former point. It is always startling to see how relatively small differences in rates add up to very significant sums over a period of years. That is why, even though we are shooting for more, we feel that a few percentage points advantage over the Dow is a very worthwhile achievement. It can mean a lot of dollars over a decade or two. January 18, 1964. Mona Lisa. Now to the pulse-quickening portion of our essay. Last year, in order to drive home the point on compounding, I took a potshot at Queen Isabella and her financial advisors. You will remember they were euchred into such an obviously low compound situation as the discovery of a new hemisphere. Since the whole subject of compounding has such a crass ring to it, I will attempt to introduce a little class into this discussion by turning to the art world. Francis I of France paid 4,000 écus in 1540 for Leonardo da Vinci's Mona Lisa. On the off chance that a few of you have not kept track of the fluctuations of the écu, 4,000 converted out to about $20,000. If Francis had kept his feet on the ground and he and his trustees had been able to find a 6% after-tax investment, the estate now would be worth something over $1 quadrillion. That's $1 quadrillion, or over 3,000 times the present national debt, all from 6%. I trust this will end all discussion in our household about any purchase of paintings qualifying as an investment. However, as I pointed out last year, there are other morals to be drawn here. One is the wisdom of living a long time. The other impressive factor is the swing produced by relatively small changes in the rate of compound. A table showing the gains from $100,000 compounded at various rates can be found on the enhancement. It is obvious that a variation of merely a few percentage points has an enormous effect on the success of a compounding investment program. It is also obvious that this effect mushrooms as the period lengthens. If, over a meaningful period of time, Buffett partnership can achieve an edge of even a modest number of percentage points over the major investment media, its function will be fulfilled. January 18, 1965. Manhattan Indians. Readers of our early annual letters registered discontent at a mere recital of contemporary investment experience, but instead hungered for the intellectual stimulation that only could be provided by a depth study of investment strategy spanning the centuries. Hence, this section. Our last two excursions into the mythology of financial expertise have revealed that purportedly shrewd investments by Isabella, backing the voyage of Columbus, and Francis I, original purchase of Mona Lisa, bordered on fiscal lunacy. Apologists for these parties have presented an array of sentimental trivia. Through it all, our compounding tables have not been dented by attack. Nevertheless, one criticism has stung a bit. The charge has been made that this column has acquired a negative tone, with only the financial incompetence of history receiving comment. We have been challenged to record on these pages a story of financial perspicacity which will be a benchmark of brilliance down through the ages. One story stands out. This, of course, is the saga of trading acumen etched into history by the Manhattan Indians when they unloaded their island to that notorious spendthrift Peter Minuit in 1626. My understanding is that they received $24 net. For this, Minuit received 22.3 square miles, which works out to about 621,688,320 square feet. While on the basis of comparable sales, it is difficult to arrive at a precise appraisal, a $20 per square foot estimate seems reasonable, giving a current land value for the island of $12,433,766,400, $12.5 billion. To the novice, perhaps this sounds like a decent deal. However, the Indians have only had to achieve a 6.5% return, the tribal mutual fund representative would have promised them this, to obtain the last laugh on Minuit. At 6.5%, $24 becomes $42,105,772,800, $42 billion in 338 years. And if they just manage to squeeze out an extra half point to get to 7%, the present value becomes $205 billion. So much for that. Some of you may view your investment policies on a shorter-term basis. For your convenience, we include our usual table indicating the gains from compounding $100,000 at various rates on the enhancement. This table indicates the financial advantages of 1. A long life. In the erudite vocabulary of the financial sophisticate, this is referred to as the Methuselah technique. 2. A high compound rate. 3. A combination of both, especially recommended by this author. To be observed are the enormous benefits produced by relatively small gains in the annual earnings rate. This explains our attitude which, while hopeful of achieving a striking margin of superiority over average investment results, nevertheless regards every percentage point of investment return above average as having real meaning. Wisdom compounded. Buffett understands the power of compound interest as well as anyone. His stories offer, in his humorous and folksy way, invaluable examples of the costs and benefits derived from minor changes in the average rate of gains or the length of the compounding program. In addition to Graham's lesson that stocks are businesses and the market is there to serve, not inform, we now have another mantra. Investment decisions should be made on the basis of the most probable compounding of after-tax net worth with minimum risk. Everyone has the ability to think and invest this way, and those who do gain a significant competitive edge over many other investors operating under a win-now mentality. The big question from here, which we'll explore next, is, Given your interest and capabilities, should you try to pick stocks and follow Buffett's lead as a stock picker, or should you simply dollar-cost average your way to prosperity by increasing your share of American business through a low-cost index over a lifetime? Doing nothing else but indexing is a highly attractive option. Relative to the little time or effort required, the results, compounded over many years, can actually be remarkably good. For most people, this will be the best choice. Chapter 3. Market Indexing, the Do-Nothing Rationale. The Dow as an investment competitor is no pushover, and the great bulk of investment funds in the country are going to have difficulty in bettering, or perhaps even matching, its performance. January 24, 1962. As detailed in the last chapter, Buffett told partners he expected the market to compound at around a 5 to 7% per year rate, on average and over the very long run, 20 to 30 years. At the high end of his range, that meant the market would roughly double every 10 years or so. Such is the power of American business and compound interest. Today, investors can harness this power by simply owning the entire market through a low-cost index fund. This is one of the best strategies going. It's the do-nothing approach. Its main benefit, aside from working so well, is that it's cheap and easy to implement on your own. You certainly don't need to pay anyone a big fee to tell you to just buy the market, sit back, and latch on to the power of compounding. John Bogle founded the Vanguard 500 Index Fund in 1975 and created the first security that itself owned a slice of every company in the S&P 500 index. However, index investing wasn't around in the Buffett Partnership Limited (BPL) era. Had partners not been invested with Buffett, they most likely would have been invested in a trust or mutual fund. For this reason, each of Buffett's year-end letters included a comparison table of BPL's performance, the market's performance, and the results of a handful of the leading investment companies. Here is the reason he gave partners. In outlining the results of investment companies, I do so not because we operate in a manner comparable to them, or because our investments are similar to theirs. It is done because such funds represent a public batting average of professional, highly paid investment management handling a very significant $20 billion of securities. Such management, I believe, is typical of management handling even larger sums. As an alternative to an interest in the partnership, I believe it reasonable to assume that many partners would have investments managed similarly. Buffett carefully points out that the broad market average is likely to be the tougher competitor, and that the majority of actively managed funds will tend to underperform the Dow. Higher standards for today's mutual funds. With no other alternative available, it's no surprise that Buffett excused this underperformance at the time. The collective record of such investment media is necessarily tied to the record of corporate America. Their merits, except in the unusual case, do not lie in superior results or greater resistance to decline in value. Rather, I feel they earn their keep by the ease of handling, the freedom from decision-making, and the automatic diversification they provide, plus, perhaps most important, the insulation afforded from temptation to practice patently inferior techniques which seem to entice so many would-be investors. The simple truth is that John Bogle, through the advent of the low-cost index fund, significantly raised the bar for mutual funds and all the other products that had previously existed to provide investors ease of handling and broad diversification. Index funds do that better. Today, all active investors, both professional and individual, have to outperform to justify their action. Most don't. Many funds, especially the ones investing in hundreds of stocks at a time, Buffett calls these the Noah's Ark school of investing, two of everything, appear to be clinging to a business model whose extinction seems almost inevitable. Vanguard and the other index products like it have steadily taken share from active managers since they became available 40 years ago. To what extent is the mutual fund industry a buggy whip business as a result of this new competitor? It is a question that has loomed larger in recent years given the huge majority of funds that have failed to do better than their lower-cost competitor. Who would want to pay a higher fee for a lower return? Of course, any professional investor who outperforms over an extended period of time adds significant value and will always be in demand, whether their structure is mutual, partnership, hedge fund, or otherwise, no matter how many stocks they own. Even modestly better results produce tremendous financial advantages when compounded over time. However, the majority of those who invest on their own or through actively managed mutual funds underperform the market. The chance of doing better by investing actively as opposed to passively comes with a significant risk that results will actually be worse. Buffett's last will and testament reflects his own view on the matter particularly well, which he outlined in his 2013 annual letter. Both individuals and institutions will constantly be urged to be active by both those who profit from giving advice or effecting transactions. The resulting frictional costs can be huge and, for investors in aggregate, devoid of benefit. So ignore the chatter, keep your costs minimal, invest in stocks as you would a farm. My money, I should add, is where my mouth is. What I advise here is essentially identical to certain instructions I've laid out in my will. One bequest provides that cash will be delivered to a trustee for my wife's benefit. I have to use cash for individual bequests because all of my Berkshire shares will be fully distributed to certain philanthropic organizations over the 10 years following the closing of my estate. My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the Trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals, who employ high-fee managers. Buffett has been teaching investors for a very long time that you can't get much more from the market than what you put into it. If you're uninterested, unable, or unwilling to dedicate the time and effort to your investments, you should buy the index. The only reason to choose an active investment program is a belief that you or the investment manager you've chosen will outperform the do-nothing strategy. Most funds fail to flap their wings. Even in the absence of index funds in the 1960s, Buffett understood this idea intuitively. He saw the Dow as his main competitor, and outperforming it was his principal objective. He saw absolute performance, the percentage gain or loss a fund achieves in any given year, as largely a matter of random luck. For investors, skill is measured through relative performance, how much better or worse one's returns are relative to the market. Here is how he put it. The results of these investment companies, in some ways, resemble the activity of a duck sitting on a pond. When the water, the market, rises, the duck rises. When it falls, back goes the duck. I think the duck can only take the credit or blame for his own activities. The rise and fall of the lake is hardly something for him to quack about. The water level has been of great importance to BPL's performance. However, we have also occasionally flapped our wings. While the term index fund was still a decade away, the term behavioral finance would take much longer to enter the lexicon. Remarkably, Buffett anticipated both of these related investing megatrends, the importance of the index as the primary yardstick and the psychological factors leading to the chronic underperformance of active managers. Why do smart, well-staffed, well-resourced, well-connected, experienced investment managers so consistently fail to beat an unmanaged index? Writing in 1965, Buffett offered his own opinion. This question is of enormous importance, and you would expect it to be the subject of considerable study by investment managers and substantial investors. Curiously enough, there is practically nothing in the literature of Wall Street attracting this problem, and discussion of it is virtually absent at security analyst society meetings, conventions, seminars, etc. My opinion is that the first job of any investment management organization is to analyze its own techniques and results before pronouncing judgment on the managerial abilities and performance of the major corporate entities of the United States. In the great majority of cases, the lack of performance exceeding or even matching an unmanaged index in no way reflects lack of either intellectual capacity or integrity. I think it is much more the product of 1. Group decisions. My perhaps jaundiced view is that it is close to impossible for outstanding investment management to come from a group of any size, with all parties really participating in decisions. 2. A desire to conform to the policies and, to an extent, the portfolios of other large, well-regarded organizations. 3. An institutional framework whereby average is safe and the personal rewards for independent action are in no way commensurate with the general risk attached to such action. 4. An adherence to certain diversification practices which are irrational. And finally, and importantly, 5. Inertia. Classical economic theory assumes individuals always behave rationally. But prospect theory, Daniel Kahneman and Amos Tversky's foundational paper uprooting this idea, showed how economic decisions are often not rational in the classic sense. Kahneman was awarded the Nobel Prize in 2002. It ushered in behavioral economics and a new way of thinking when it was published in 1979, but keep in mind that this was nearly 15 years after Buffett's own critique. The advice to investors is clear and straightforward. Seriously consider a low-cost, passive index fund as your best investment choice. While the benefits of compounding at an above-market rate are clear, most investors fail to do so. Picking stocks is hard. Investors who decide to follow Buffett down the road of active investment cannot say that Professor Buffett has not weighed in with ample warnings ahead of time, suggesting they take an alternate route. From the Partnership Letters, the case for passive investing. Note: the performance table Buffett included in each year-end letter and referred to in the following excerpts can be found in Appendix A, which is included in the enhancement. January 24, 1962. You may feel I have established an unduly short yardstick in that it perhaps appears quite simple to do better than an unmanaged index of 30 leading common stocks. Actually, this index has generally proven to be a reasonably tough competitor. July 6, 1962. To the extent that funds are invested in common stocks, whether the manner of investment be through investment companies, investment counselors, bank trust departments, or do-it-yourself, our belief is that the overwhelming majority will achieve results roughly comparable to the Dow. Our opinion is that the deviations from the Dow are much more likely to be toward a poorer performance than a superior one. January 24, 1962. My own record of investing such huge sums of money, with restrictions on the degree of activity I might take in companies where we had investments, would be no better if as good. I present this data to indicate the Dow as an investment competitor is no pushover, and the great bulk of investment funds in the country are going to have difficulty in bettering or perhaps even matching its performance. January 18, 1964. Within their institutional framework and handling the many billions of dollars involved, the results achieved are the only ones attainable. To behave unconventionally within this framework is extremely difficult. Therefore, the collective record of such investment media is necessarily tied to the record of corporate America. Their merits, except in the unusual case, do not lie in superior results or greater resistance to decline in value. Rather, I feel they earn their keep by the ease of handling, the freedom from decision-making, and the automatic diversification they provide, plus, perhaps most important, the insulation afforded from temptation to practice patently inferior techniques, which seem to entice so many would-be investors. January 18, 1965. The repetition of these tables has caused partners to ask, why in the world does this happen to very intelligent managements working with 1. Bright, energetic staff people, 2. Virtually unlimited resources, 3. The most extensive business contacts, and 4. literally centuries of aggregate investment experience. The latter qualification brings to mind the fellow who applied for a job and stated he had 20 years of experience, which was corrected by the former employer to read 1 year's experience 20 times. This question is of enormous importance, and you would expect it to be the subject of considerable study by investment managers and substantial investors. After all, each percentage point on $30 billion is $300 million per year. Curiously enough, there is practically nothing in the literature of Wall Street attracting this problem, and discussion of it is virtually absent at Security Analyst Society meetings, conventions, seminars, etc. My opinion is that the first job of any investment management organization is to analyze its own techniques and results before pronouncing judgment on the managerial abilities and performance of the major corporate entities of the United States. In the great majority of cases, the lack of performance exceeding or even matching an unmanaged index in no way reflects lack of either intellectual capacity or integrity. I think it is much more the product of 1. Group decisions. My perhaps jaundiced view is that it is close to impossible for outstanding investment management to come from a group of any size with all parties really participating in decisions. 2. A desire to conform to the policies and, to an extent, the portfolios of other large, well-regarded organizations. 3. An institutional framework whereby average is safe and the personal rewards for independent action are in no way commensurate with the general risk attached to such action. 4. An adherence to certain diversification practices which are irrational. And finally, and importantly, 5. Inertia. Perhaps the above comments are unjust. Perhaps even our statistical comparisons are unjust. Both our portfolio and method of operation differ substantially from the investment companies in the table. However, I believe both our partners and their stockholders feel their managements are seeking the same goal: the maximum long-term average return on capital obtainable with the minimum risk of permanent loss consistent with a program of continuous investment in equities. Since we should have common goals, and most partners, as an alternative to their interest in BPL, would probably have their funds invested in media producing results comparable with these investment companies, I feel their performance record is meaningful in judging our own results. There is no question that an important service is provided to investors by investment companies, investment advisors, trust departments, etc. This service revolves around the attainment of adequate diversification, the preservation of a long-term outlook, the ease of handling investment decisions and mechanics, and, most importantly, the avoidance of the patently inferior investment techniques which seem to entice some individuals. All but a few of the organizations do not specifically promise to deliver superior investment performance, although it is perhaps not unreasonable for the public to draw such an inference from their advertised emphasis on professional management. One thing I pledge to you as partners, just as I consider the previously stated performance comparison to be meaningful now, so will I in future years, no matter what tale unfolds. Correspondingly, I ask that you, if you do not feel such a standard to be relevant, register such disagreement now, and suggest other standards which can be applied prospectively rather than retrospectively. One additional thought: I have not included a column in my table for the most widely used investment advisor in the world, Bell Management. People who watch their weight, golf scores, and fuel bills seem to shun quantitative evaluation of their investment management skills, although it involves the most important client in the world, themselves. While it may be of academic interest to evaluate the management accomplishments of Massachusetts Investors Trust or Lehman Corporation, it is of enormous dollars and cents importance to evaluate objectively the accomplishments of the fellow who is actually handling your money, even if it's you. July 9, 1965. Of course, the beauty of the American economic scene has been that random results have been pretty darned good results. The water level has been rising. In our opinion, The probabilities are that over a long period of time it will continue to rise, though certainly not without important interruptions. It will be our policy, however, to endeavor to swim strongly with or against the tide. If our performance declines to a level you can achieve by floating on your back, we will turn in our suits. Wisdom compounded. The advent of the low-cost index fund was a game-changer for the traditional mutual fund industry. Their primary role of providing ease of handling and keeping individuals from picking stocks themselves was replaced by a superior lower-cost product. Indexing, or passive investing, has been growing in popularity at a largely uninterrupted pace since the products were introduced in the late 1970s. Buffett himself, in providing for his wife in his will, chose an index fund over an actively managed one. That fact alone should give every investor pause. Fees, taxes, and psychology are all working against the active manager, and the results you're likely to get as an index investor are not only pretty good, but they also require little to no thought or effort. You can design an investment program using low-cost index funds in well under an hour, then set it and forget it for the decades that follow. All that being said, the financial benefits from sustained outperformance are equally compelling if you can find a way to do it. Clearly, not everyone can be above average. Given what's at stake, if you decide the active route is the path for you, you'll need an objective system to test your results, whether they are yours or the results of a professional manager. So far, Buffett's lessons from the letters have revolved around 6 key ideas for all investors. Think of stocks, 1, as fractional claims on entire businesses, 2, that swing somewhat erratically in the short term, but 3, behave more in line with their gains in intrinsic business value over the longer term, which, when 4, viewed through the lens of a long-term compounding program, 5, tend to produce pretty good results, which, with 6, an index product can be captured efficiently in a low-cost, easy-to-implement way. From here, we're going to turn to Buffett as an active investor, starting with his ideas on what exactly he's setting out to achieve and how he intends to measure it. Chapter 4. Measuring Up. The Do-Nothings versus the Do-Somethings. If our performance declines to a level you can achieve by floating on your back, we will turn in our suits. July 9, 1965. The proper measurement of active investment performance is so critical to Buffett that he dedicated 2 of the original 8 ground rules to it. Poor measurement, in Buffett's view, is a dangerous investment sin. He sets 2 fundamental rules to A. Establish the measurement how, which is based on a relative-to-market performance test, and then B. Establish the measurement how long, which sets forth the minimum span over which an investment operation can be judged. The outstanding item of importance in my selection of partners, as well as in my subsequent relations with them, has been the determination that we use the same yardstick. If my performance is poor, I expect partners to withdraw, and indeed I should look for a new source of investment for my own funds. If performance is good, I am assured of doing splendidly, a state of affairs to which I am sure I can adjust. As we learned earlier, the power of compound interest means that even a modest amount of outperformance can produce huge incremental increases in your ultimate results over time. If your methods are underperforming the broad market on a 3- or 5-year basis, however, it makes sense to stop and seriously consider throwing in the towel, Buffett's words, and buying the index. As an investor, the only way to know how you are doing is to develop and apply a properly formulated test. Buffett gives us the tools to do exactly that. 1. Ground rule number 4. Whether we do a good job or a poor job is not to be measured by whether we are plus or minus for the year. It is, instead, to be measured against the general experience in securities as measured by the Dow Jones Industrial Average, leading investment companies, etc. If our record is better than that of these yardsticks, we consider it a good year, whether we are plus or minus. If we do poorer, we deserve the tomatoes. 2. Ground rule number 5. While I much prefer a 5-year test, I feel 3 years is an absolute minimum for judging performance. It is a certainty that we will have years when the partnership performance is poorer, perhaps substantially so, than the Dow. If any 3-year or longer period produces poor results, we all should start looking around for other places to have our money. An exception to the latter statement would be 3 years covering a speculative explosion in a bull market. These two simple measures still work perfectly well for investors today. The first test measures each year's results relative to the market's performance. We simply don't care if we are up or down in any given year. Instead, we focus on whether the year has been better or worse than the market average. Because the general trend is up, if you can manage to be down a little less in down markets and up a little more in up markets, your performance will likely be stellar. Investors simply want to beat the averages on a relative basis cumulatively and as often as possible, letting the plus and minus years fall where they may in absolute terms. The second test Buffett gives investors establishes that relative performance should be measured on at least a 3-year trailing basis to be relevant, and that a 5-year test is even better. Again, those that chronically fail to outperform over a 3 to 5 year period for any reason should consider finding something else to do with their funds. After all, why bother expending all that effort for a poorer result? Buffett insisted that all his partners were in agreement with this approach. Everyone had to be in tune with his relative versus the market yardstick and his 3-year test before the first dollar was put to work. He made a consistent effort to educate each subsequent new partner about these standards, which he often repeated in the letters. It's not that he insisted his standards were the best or that others weren't equally valid, but these were his standards, and he made it clear that only those who agreed with them should be in the partnership. If he achieved what he set out to do, he wanted to receive the proper hosannas. If not, he expected partners to withdraw. The takeaway for the rest of us is to establish and ensure the yardsticks are in place ahead of time in order to avoid any misunderstanding about what you should be cheering for. Because, as Buffett puts it, you don't want soft fruit thrown when the expectation is for vigorous applause. If all the professional money managers adhered to his standards, we'd witness a record number of early retirements on Wall Street. Buffett continues to hold himself to a 5-year yardstick of relative performance today at Berkshire Hathaway. It was, and continues to be, a very high bar. All investors need a yardstick. If you can devise a better test, great, but be sure to establish it in advance. Ambitious goals. Buffett's own performance goals for the partnership would not be achieved easily. After first establishing what he was trying to avoid, 3 to 5 year rolling relative underperformance, he laid out his aim to beat the Dow by an average margin of 10 points per year. This was the maximum amount of advantage he thought one could achieve, and he aimed to capture it. So if the Dow was minus 5% on the year, he hoped to be plus 5%. Investors might ask what the origin of this 10% figure was, and, to be honest, I'm not sure. However, it's not a question I have spent much time thinking about. We should be more than satisfied if we can manage to do even marginally better than the market over time. Inquiring about the ceiling of our potential outperformance is putting the cart in front of the horse. While he had no idea what any given year would bring in the overall market, you'll recall he figures 5 to 7% will be the average. The additional 10% advantage meant he was aiming for 15 to 17% average annual returns. $100,000 compounded at 15% for 10 years grows to $405,000, and after 20 years to $1.6 million. This result would be staggeringly good. Virtually every comment he makes regarding performance is made on a relative basis. At one point, he explains his thinking as if he were talking to a golfing buddy. I would consider a year in which we declined 15% and the average 30% to be much superior to a year when both we and the average advanced 20%. Over a period of time, there are going to be good and bad years. There is nothing to be gained by getting enthused or depressed about the sequence in which they occur. The important thing is to be beating par. A 4 on a par 3 hole is not as good as a 5 on a par 5 hole, and it is unrealistic to assume we are not going to have our share of both par 3s and par 5s. Investors are taught to think about performance in one way. If the market is down and you are down less, you've had a good year, and vice versa. As long as your performance is even slightly better than the market average, whether the outperformance comes in up or in down markets, the results will likely be excellent. While the partnership never had a down year, or even a year that underperformed the market, Buffett trained investors to expect both. His skill as an investor, the advantage of working with relatively smaller sums, a market that was right for his style, and luck, were all factors that helped the partnership achieve such consistently outstanding results. But since then, Berkshire has had a handful of underperforming years and a couple that were down, albeit modestly. The best test is a long test. Investors should not expect too much consistency from any style of investing. Everything will have its seasons. With the understanding that his own relative performance would likely vary, Buffett warned he could very well lag the market by as much as 10% in the bad years, and thought he could be up as much as 25% when everything clicks. Because of the wide expected amplitude between any two given years, he felt it essential that investors should measure their results over a multi-year period, and thought 3 years was the absolute minimum. He much preferred 5. The best test would be conducted over a flat market period. That way, changes in the speculative fervor of the overall market would be removed as a factor. He taught and reminded investors that even a given year's relative performance was largely a matter of luck. It relies on the voting machine nature of short-term market movements. As you stretch out your evaluation horizon, the test becomes more and more like a weighing machine. Buffett also teaches investors that there is one important caveat to the multi-year test. Underperformance in the late stages of a speculative bull market is highly likely. It's a caveat that he repeats to this day. We saw this effect in the final few years of the partnership, when a few performance funds were trouncing BPL during the go-go era leading up to the devastating market crash in the early 1970s, and then again more recently when Buffett and Berkshire Hathaway were seen as out of step, just before the bursting of the Internet bubble in the 2000s. Market manias in their full speculative ferment cause stocks to become divorced from the business fundamentals. Those who view the market as a voting machine thrive in these environments, while Buffett and other investors, who consider themselves members of the weighing machine school, will appear to be out of step. Because of the conservative nature of his value-oriented investment style, Buffett teaches us to generally expect better relative performance in down markets. Again, he was perfectly fine with being down in such periods, but he expected to be down less than the market as a whole. Investors following these principles today should share in this expectation. Because of the methods deployed and the types of securities purchased, down markets tend to show the best performance. As Buffett told partners in 1962, "A declining Dow gives us our chance to shine and pile up the percentage advantages which, coupled with only an average performance during advancing markets, will give us quite satisfactory long-term results. Our target is an approximately 0.5% decline for each 1% decline in the Dow, and if achieved, means we have a considerably more conservative vehicle for investment in stocks than practically any alternative." Buffett reminds investors that principles, including those that measure performance, don't change. He insisted on a minimum 3-year test for active managers versus the market when the industry wasn't really measuring at all. By the end of the 1960s, the industry had gone from not measuring up at all to measuring up way too frequently. He was still advocating a minimum 3-year test when these folks were measuring by the minute, which was just as bad as not measuring at all. We learn from Buffett to think about performance measurement in a way that's internally consistent with the other core tenets. If we set out as our first principle that the stock market is not very efficient, it would be inconsistent to think our own short-term performance is something to pay attention to. The squiggles, as it were, are for giggles. We should only care about trailing 3-year figures at a minimum, because that is the threshold where markets can be expected to become efficient. 5 years is better. A full market cycle is the best period over which to evaluate an active manager, market low to market low or market high to market high. From the Partnership Letters, Measuring Up. January 24, 1962. A word about par. The outstanding item of importance in my selection of partners, as well as in my subsequent relations with them, has been the determination that we use the same yardstick. If my performance is poor, I expect partners to withdraw, and indeed I should look for a new source of investment for my own funds. If performance is good, I am assured of doing splendidly, a state of affairs to which I am sure I can adjust. The rub, then, is in being sure that we all have the same ideas of what is good and what is poor. I believe in establishing yardsticks prior to the act. Retrospectively, almost anything can be made to look good in relation to something or other. I have continuously used the Dow Jones Industrial Average as our measure of par. It is my feeling that 3 years is a very minimal test of performance, and the best test consists of a period at least that long where the terminal level of the Dow is reasonably close to the initial level. While the Dow is not perfect, nor is anything else, as a measure of performance, it has the advantage of being widely known, has a long period of continuity, and reflects with reasonable accuracy the experience of investors generally with the market. I have no objection to any other method of measurement of general market performance being used, such as other stock market averages, leading diversified mutual stock funds, bank common trust funds, etc. July 8, 1964. We will regularly follow this policy wherever it may lead. It is, perhaps, too obvious to say that our policy of measuring performance in no way guarantees good results. It merely guarantees objective evaluation. I want to stress the points mentioned in the ground rules regarding application of the standard, namely, that it should be applied on at least a 3-year basis because of the nature of our operation, and also that during a speculative boom we may lag the field. However, one thing I can promise you. We started out with a 36-inch yardstick, and we'll keep it that way. If we don't measure up, we won't change yardsticks. In my opinion, the entire field of investment management, involving hundreds of billions of dollars, would be more satisfactorily conducted if everyone had a good yardstick for measurement of ability and sensibly applied it. This is regularly done by most people in the conduct of their own business when evaluating markets, people, machines, methods, etc., and money management is the largest business in the world. January 20th, 1966. I certainly do not believe the standards I utilize and wish my partners to utilize in measuring my performance are the applicable ones for all money managers. But I certainly do believe anyone engaged in the management of money should have a standard of measurement, and that both he and the party whose money is managed should have a clear understanding why it is the appropriate standard, what time period should be utilized, etc. Frank Block put it very well in the November-December 1965 issue of the Financial Analyst's Journal. Speaking of measurement of investment performance, he said, "However, the fact is that literature suffers a yawning hiatus in this subject. If investment management organizations sought always the best performance, there would be nothing unique in careful measurement of investment results. It does not matter that the customer has failed to ask for a formal presentation of the results. Pride alone should be sufficient to demand that each of us determine objectively the quality of his recommendations. This can hardly be done without precise knowledge of the outcome. Once this knowledge is in hand, it should be possible to extend the analysis to some point at which patterns of weakness and strength begin to assert themselves. We criticize a corporate management for failure to use the best of tools to keep it aware of the progress of a complicated industrial organization. We can hardly be excused for failure to provide ourselves with equal tools to show the efficiency of our own efforts to handle other people's money. Thus, it is our dreary duty to report that systems of performance measurement are not automatically included in the data processing programs of most investment management organizations. The sad fact is that some seem to prefer not to know how well or poorly they are doing. January 20th, 1966. Frankly, I have several selfish reasons for insisting that we apply a yardstick and that we both utilize the same yardstick. Naturally, I get a kick out of beating par. In the lyrical words of Casey Stengel, "Show me a good loser, and I'll show you a loser." More importantly, I ensure that I will not get blamed for the wrong reason, having losing years, but only for the right reason, doing poorer than the Dow. Knowing partners will grade me on the right basis helps me do a better job. Finally, setting up the relevant yardsticks ahead of time ensures that we will all get out of this business if the results become mediocre or worse. It means that past successes cannot cloud judgment of current results. It should reduce the chance of ingenious rationalizations of inept performance. Bad lighting has been bothering me at the bridge table lately. While this masochistic approach to measurement may not sound like much of an advantage, I can assure you from my observations of business entities that such evaluation would have accomplished a great deal in many investment and industrial organizations. So, if you are evaluating others or yourself in the investment field, think out some standards, apply them, interpret them. If you do not feel our standard, a minimum of a 3-year test versus the Dow, is an applicable one, you should not be in the partnership. If you do feel it is applicable, you should be able to take the minus years with equanimity in the visceral regions, as well as the cerebral regions, as long as we are surpassing the results of the Dow. January 24th, 1962. Over any long period of years, I think it likely that the Dow will probably produce something like 5% to 7% per year, compounded from a combination of dividends and market value gain. Despite the experience of recent years, anyone expecting substantially better than that from the general market probably faces disappointment. Our job is to pile up yearly advantages over the performance of the Dow without worrying too much about whether the absolute results in a given year are a plus or a minus. I would consider a year in which we were down 15% and the Dow declined 25% to be much superior to a year when both the partnership and the Dow advanced 20%. I have stressed this point in talking with partners and have watched them nod their heads with varying degrees of enthusiasm. It is most important to me that you fully understand my reasoning in this regard and agree with me not only in your cerebral regions, but also down in the pit of your stomach. For the reasons outlined in my method of operation, our best years relative to the Dow are likely to be in declining or static markets. Therefore, the advantage we seek will probably come in sharply varying amounts. There are bound to be years when we are surpassed by the Dow, but if over a long period we can average 10 percentage points per year better than it, I will feel the results have been satisfactory. Specifically, if the market should be down 35% or 40% in a year, and I feel this has a high probability of occurring one year in the next 10, no one knows which one, we should be down only 15% or 20%. If it is more or less unchanged during the year, we would hope to be up about 10 percentage points. If it is up 20% or more, we would struggle to be up as much. The consequence of performance such as this over a period of years would mean that if the Dow produces a 5% to 7% per year overall gain compounded, I would hope our results might be 15% to 17% per year. The above expectations may sound somewhat rash, and there is no question but that they may appear very much so when viewed from the vantage point of 1965 or 1970. It may turn out that I am completely wrong. However, I feel the partners are certainly entitled to know what I am thinking in this regard, even though the nature of the business is such as to introduce a high probability of error in such expectations. In any one year, the variations may be quite substantial. This happened in 1961, but fortunately the variation was on the pleasant side. They won't all be. July 8, 1964. When the water, the market, rises, the duck rises. When it falls, back goes the duck. SPCA or no SPCA, I think the duck can only take the credit or blame for his own activities. The rise and fall of the lake is hardly something for him to quack about. The water level has been of great importance to BPL's performance. However, we have also occasionally flapped our wings. January 18, 1965. I would like to emphasize that the above is conjecture, perhaps heavily influenced by self-interest, ego, etc. Anyone with a sense of financial history knows this sort of guesswork is subject to enormous error. It might better be left out of this letter, but it is a question frequently and legitimately asked by partners. Long-range expectable return is the primary consideration of all of us belonging to BPL, and it is reasonable that I should be put on record, foolish as that may later make me appear. My rather puritanical view is that any investment manager, whether operating as broker, investment counselor, trust department, investment company, etc., should be willing to state unequivocally what he is going to attempt to accomplish and how he proposes to measure the extent to which he gets the job done. Wisdom compounded. No matter how others in the market were changing their yardsticks, no matter whether they were measuring too infrequently or too often, Buffett teaches us never to change ours. It is the market that changes around the investor's fixed mindset. The market never holds sway over us. Speculative bull markets aside, Buffett thought he could beat the market by a wide margin. He teaches us to establish clear, consistent measurements so that performance can be monitored and judged fairly and accurately. He spells out ahead of time exactly what we are setting out to do, and he encourages us to regularly test ourselves against that yardstick. Today, performance measurement in the field of equity investment has been largely corrupted and obfuscated with terms like alpha, beta, Sharpe ratios, Trainer ratios, and so forth. It doesn't have to be all that complicated. Investors who decide to go the active route simply need to think it through ahead of time and commit to sticking to a measurement plan. Whether actively investing on your own or through a professional, monitor the 3- and 5-year trailing results, and when there is chronic underperformance in the absence of speculative bull market runs, strongly consider making a change. The effect of long-term underperformance is just too costly. This makes the selection of a potential new investment manager very important and requires an understanding of the power of the incentives in governing how a manager is likely to behave. By studying the way Buffett structured the partnership, which we'll do next, you'll see the areas of potential conflict between an investor and an investment manager that should be minimized to the greatest extent possible. Chapter 5. The Partnership. An Elegant Structure. The new partnership will represent my entire investment operation in marketable securities, so that my results will have to be directly proportional to yours, subject to the advantage I obtain if we do better than 6%. July 22, 1961. Incentive dictates behavior. Whether we're talking about investment managers, business leaders, or politicians, more often than not, people will behave according to what they're being rewarded for. By understanding how and why an investment manager gets paid, you can compare their expected behavior with your own best interest. While most people get the idea that you get what you reward for, the magnitude of this superpower's influence is often underestimated. As Charlie Munger has said, "I think I've been in the top 5% of my age cohort almost my entire adult life in understanding the power of incentives, and yet I've always underestimated that power. Never a year passes but I get some surprise that pushes a little further my appreciation of incentive superpower." An example from FedEx is one of his favorite cases in point. As he explains, the integrity of the FedEx system relies heavily on the ability to unload and then quickly reload packages at one central location within an allotted time. Years ago, the company was having a terrible problem getting its workers to get all the boxes off and then back on the planes in time. They tried numerous different things that didn't work, until someone had the brilliant idea of paying the workers by the shift as opposed to by the hour. Poof, the problem was solved. FedEx's old pay-by-the-hour system rewarded those who took longer to get the job done. They were incentivized to take longer. By switching to pay-by-the-shift, workers were motivated to work faster and without error so they could go home, yet still earn the wages of a full shift. For the workers, finishing early amounted to a higher effective hourly wage. By aligning the business's interests with the workers' incentives, FedEx got the outcome it and its workers both desired. The investment management business is no different. If you want ants to come, you put sugar on the floor. If you want your investment manager to behave with your best interests in mind, you have to ensure that your interests are aligned. Buffett was masterfully aligned with his investors. The Buffett Partnership Basics. The partnership was modeled from Newman Graham, one of the earliest hedge funds in the country. Graham had pioneered the basic structure. It had a general partner, the GP, Buffett, who was responsible for the management and took a percentage of the profits. The limited partners, the LPs, like Aunt Alice, contributed capital but had no say in how funds were deployed. Here is Buffett describing how the first partnership came together when he returned to Omaha after Graham Newman at the age of 25. I had no plans to start a partnership or even have a job. I had no worries as long as I could operate on my own. I certainly did not want to sell securities to other people again. But by pure accident, 7 people, including a few of my relatives, said to me, "You used to sell stocks, and we want you to tell us what to do with our money." I replied, "I'm not going to do that again, but I'll form a partnership like Ben and Jerry had, and if you want to join me, you can." My father-in-law, my college roommate, his mother, my Aunt Alice, my sister, my brother-in-law, and my lawyer all signed on. I also had my $100. That was the beginning, totally accidental. The first partnership was started with people he cared about deeply. There is no doubt that these feelings influenced the way he formulated the specifics of each partnership's fee structure. 10 more separate partnerships were formed between 1956 and 1961. As partnerships were added, Buffett offered different terms depending on the risk tolerance of each new group. He knew most of joining partners personally. Many lived in Omaha. In each case, Buffett took a percentage of the gains beyond a certain return threshold, which is called the interest provision. Generally, when he took more of the risk himself, he took a greater percent of the overage. Across the 11 partnerships, the interest provisions ranged from 0% to 6%, after which the excess to the general partner kicked in. The earliest partnership had a loss-sharing provision where Buffett agreed to personally absorb a percentage of any losses. He was consistently fair and accommodating to the needs and risk tolerance of the different partners. Those willing to take more risk were charged a lower fee. When he took on additional risk, he charged more. 1 BPL. While he started with $105,100 and a single partnership, by 1960 assets had grown to $1,900,000 across 7 distinct partnerships, and it was getting a bit unwieldy. He indicated his desire to merge the partnerships for the first time, acknowledging the issue of varying performance across partnerships. The family is growing. There has been no partnership which has had a consistently superior or inferior record compared to our group average, but there has been some variance each year despite my efforts to keep all partnerships invested in the same securities and in about the same proportions. This variation, of course, could be eliminated by combining the present partnerships into one large partnership. Such a move would also eliminate much detail and a moderate amount of expense. Frankly, I am hopeful of doing something along this line in the next few years. The problem is that various partners have expressed preferences for varying partnership arrangements. Nothing will be done without unanimous consent of partners. The consolidation to one entity in 1962, Buffett Partnership Limited, BPL, removed any potential for further performance variation among partners. The move was well timed because his total partnership assets had more than tripled in a single year to $7,178,500. Buffett's personal share accounted for 14.3%, and when the collective interest of his family members was added, the Buffett family accounted for slightly more than 25%. This is a remarkably high percentage, more akin to a family office than a hedge fund or partnership. Buffett was now not just the general partner collecting fees. He and his family also had more at stake financially than any other limited partner. BPL's terms. When all partnerships were consolidated into BPL, all LPs were asked to migrate to the same universal terms. The interest provision was set at 6% for everyone, beyond which Buffett would take 25% of the gains. Since he figured the market was going up 5 to 7% a year on average, the interest provision was set at a level so he earned nothing unless he was beating the market. He had a high watermark. Any cumulative deficiency below a 6% annual gain would have to be recouped before he would resume taking his fee. Some partners relied on the partnership for income and wanted to collect on their interest provision. Others wanted the maximum amount of capital to remain invested. In order to appease both groups, the 6% would be distributed 0.5% each month to those who wanted it. Those who wished to keep their funds fully invested could choose to forego these payments, which would be reinvested back into the partnership at year-end. Let's now look at the ways Buffett's structure for the partnership was a brilliant example of how to align manager incentives and investor objectives. The ability to design simple, easy-to-understand incentive structures has remained a key source of Buffett's success throughout the partnership years, and indeed throughout his entire career. Ways managers get paid when investors don't. Today's hedge funds and mutual funds typically charge a management fee, computed as a fixed percentage of the investor's assets under management. These can range from 0.25% to 2% or more per year, and the fee is taken irrespective of performance. Because the asset management business is highly scalable, an increase in assets